Part 4. Taxes and reporting what you earn. There is a profound sense of freedom that comes with realizing it is perfectly acceptable and highly encouraged to make a significant amount of money doing exactly what you love. However, that liberation comes with a new set of rules that most professionals ignore until it's too late. When you transition away from the traditional 9-5 world, you lose the safety net of the W-2 system, where a corporate accounting department automatically withholds taxes from every paycheck. As a freelancer, consultant, personal coach, or other service provider, you are now the CEO of your own financial ecosystem, which means the responsibility for calculating, reporting, and paying your taxes falls squarely upon your shoulders. If you aren't prepared, the huge fees you've worked so hard to collect can quickly be eroded by the realities of self-employment tax and federal oversight. The goal isn't just to pay your taxes. It is to pay as little as legally possible by moving away from the amateur default settings of business ownership. Most people make the critical mistake of remaining a sole proprietor, which essentially leaves them and their personal assets exposed while offering almost zero strategic tax advantages. To truly protect your earnings, you must consciously choose a more sophisticated structure, such as an LLC or a partnership, to create a legal and financial barrier between your personal life and your professional revenue. In this section, we are going to dive into the mechanics of tax reporting and the specific structural shifts you need to make to ensure that the money you've been getting paid stays in your pocket, where it belongs. When you start looking for answers on how to handle taxes as a consultant or freelancer, you quickly realize you've entered a wilderness of conflicting information. If you go online, you'll find a million articles and finfluencers offering generic advice that sounds legit on the surface, but often collapses under the weight of a real IRS audit. They'll tell you to track your expenses or save 30%, which is fine for a hobbyist, but it doesn't tell you how to actually engineer your business to keep more of what you earn. What are they really saying? Most of it is safe, middle-of-the-road fluff designed to avoid liability, leaving you to guess which specific options actually apply to your unique situation as a high-earning service provider. The reality is that your options are far more strategic than just filling out a Schedule C at the end of the year. You have a choice in how the government views your income, how you shield your personal assets, and how you categorize every dollar that moves through your accounts. You don't need a textbook on tax law. You need a clear breakdown of the tactical moves that professionals use to stay compliant without overpaying. We're moving past the save your receipts level of advice and getting into the high-level structures that separate the amateurs from the true business owners. Part 4. Taxes and reporting what you earn as an independent business owner, freelancer, consultant, etc. This chapter is not tax advice. It is structural awareness from years of operating as a self-employed professional. You do not need to become a tax expert, but you must become tax aware. Ignoring the mechanics of how your money is taxed is a luxury you can no longer afford once you cross the threshold into high-level earnings. By understanding the strategic levers available to you, you move from being a passive payer to an active architect of your own financial security.